Okay, so this is chapter 17, part 2. So what you saw me do earlier on was more conceptual. It was very much, okay, I'm trying to, um, if you like, yes, I recognize the fact that the parent has invested a certain amount in the subsidiary. So call it like you saw what I saw there, 50. And I'm ultimately, I don't want to keep looking. I mean, it's not just what we're ultimately saying is that this subsidiary company, because you control it, it's not just some little non-current asset you have sitting in your statement of financial position, that ultimately as you control it, we want you to embody it. And when I say embody it, bring it into the body of your organization. So typically take this out and replace. So ultimately, what have I done? I've taken that out and I brought that in with this. So this is kind of, if you like, version of that. Now, this is all well and good. You can't keep doing it like this. This is just, again, conceptual. So we have a structure for really managing this process, because it does get complicated, as you can imagine. When I say complicated, there are other things involved, especially to do with this intergroup, taking out intergroups. So the intergroup relationships and goodwill. So we can't quite do it like this all the time. So what do? We have a 5 working step structure, and this is a kind of traditional method of doing this. Everyone seems to stick to this process, but I mean, I actually think, and it's true, I guess. I mean, it's it works. I don't think it's. I think what you want to do is understand it, but you also want to be comfortable with the fact that these are the mechanics of the process. So the first thing we like to do is, so we have 5 working steps, and we have this working one, and working one enables us to just understand the group structure. Who's in charge here? Who's the parent? And who's the subsidiary? What percentage do you hold? And just knowing this, because again, like I say, this is, if for you guys, sometimes you will come to see where you have a parent or the subsidiary. I mean, we saw this with tax, if you remember. And then you might have an associate you own less than 50%, probably close to 20 to 40%, something along those lines. Maybe that's an associate. You might have a number of subsidiaries. You might own different percent. So you see where I'm going. So it's important to just understand the relationship first between the parent, if you like, and its subsidiaries. Now, again, here's the issue here. When you buy a company, we're going to go through examples, but this is just the initial theory. Um, when you bought this subsidiary, when you paid this 50, right, for this organization, just conceptually, what I want you to do is pick this up. When you paid 50 as in your investment in your subsidiary, you have the subsidiary company, and if you like, here is its equity section, right? So you have, I'm just going to put whatever, 10 and 40. Maybe this is the scenario at the time. So that's share capital, and those are retained earnings. That's why it's 50. Now, after you've bought this company, well, over the next year, that subsidiary trades. Now, as you can imagine, double entry, of course, or just general accounting, the whole point of trade is to create profit. And how do we identify that profit? Yes, we can use the income statement, but we know as well that what we have to do is ultimately look at the equity section to see the increase in C. I mean, I'm not saying anything special. A is equal to C plus L. Growth is literally, this is equation 1 or whatever, in equation 2. So at the beginning of the year, end of the year, we hope that capital would have increased from C1 to C2, made up of, if you like, I minus E, blah, blah, blah. So the key point is, by honing in on the equity section of the subsidiary, we can see the growth, for example, in equity, or therefore um, profits from one year to the next. So working two is really saying that, or anything. If you think about it, I mean, what you don't see, what working two could do, it doesn't is up here. You have the A minus L. So if you have a revaluation of an asset going up, we see that evidence in the, if you like, in the equity section. If this goes up by 15, we must see that 15 move up here, if you like. If you see a devaluation here, we see the devaluation here. So the key point here is that the activity going on in the equity section tells us everything we need to know post acquisition. Everything, literally everything that's taking place. Anything that's going to happen up here is shown in the equity section. And that's what working to is really telling us. Working to, because you see, ultimately, we want to, we deserve, we need to show those profits, those additional profits in our consolidated set of accounts, right? Because I mean, ultimately, think about it like this. If you had kept this investment in your non-current assets, right, any growth, you would have this increase. If this had increased by 10, you would have 10 here, and this is in your investment up here, non-current assets, and also in your equity section you would also have this increase in profit of 10. That's all we're showing. We're basically showing that increase in the investment and that increase in the equity. It's just that now this 50 is now replaced by all the assets, which is still the same thing. So as these A's and A's increase in value, we also must see the increase, if you like, in the profit shown, if you like, additional profit that's coming in, shown within our equity section. That's the conceptual way of thinking about this, but just you'll do examples and you get used to the process. Anyway, so after acquisition, the subsidiary grows. I'm just reading again. After acquisition, the subsidiary grows, and we need to work out what the share of post-acquisition growth is, so we can include it in the parent company. And that growth is looked at or analyzed by looking at the equity section of the subsidiary. So from the point of acquisition to its current position, what are the profits since acquisition? So you set up this really cool table at excuse me, at the date of acquisition. We have the share capital, if you like, and we have all the reserves. I only used one reserve, the retained earnings in the earlier question, but you can have a range of reserves. Now, what you should see is traditionally these figures. Actually, that's not true. I was going to say these figures do not change. That's not true. They can change, but when I say they do not change, you can get a question where some more capital was issued and you just have to put the journal through. But ultimately, we're looking at movements. When I say they do not change, this is just a journal, right? This has nothing to do with profit. So if you have a journal, right, you would have debit bank and credit share capital or something and share premium. But in terms of profit movements where we're looking at a share of or the full thing to include within our retained earnings, we're looking at the movements, if you like, here in retained earnings from one year to the next. So that's what the scenario was at the date of acquisition. That's the reporting date, the year end or whatever. And this is really the difference between this and this, which is why it's referred to as post acquisition. So because we can now really focus and analyze the actual differences between date of acquisition and the reporting period to actually know what's going on, see all the differences, because things could have changed, as you can imagine, and we can then assign those differences to the right area. And that's working too, ultimately trying to find out what these profits are. Now, within the context of consolidation, things can happen, if you like, during the year, and anything that will, in effect, affect the retained earnings of this subsidiary will be shown in this working, and that's where we're really going, because I mean the subsidiary is still trading. So anything that's happening up here, A minus L, will see the effects through the retained earnings. Okay, great. So and so I'm just really saying the same thing. Yeah, so the first column as well shows the fair value of S at acquisition. So just going back here, this was S when you met it. Again, like I said, and that's how it always is. It's just sitting there. When you pay for it, it does now kind of become, it must be recognized at fair value, if you like, to make sure things are fair for the the non-controlling interest, if you like. So this is kind of upgraded. You'll see examples where this is upgraded to fair value ultimately. So we're ultimately saying here, subsidiary A minus L is equal to C. They're happily going away and just managing themselves. So you come along, you want to buy the business, but what we're really saying is, like all good businesses, you should revalue your assets in effect first. So you might get a question, nothing abnormal, that they had a building 100,000 and then that's whatever minus 20 and that's equal to 80, and then suddenly someone comes along when it's time to consolidate, we have to look at the fair value of this building. So this might be 140 now, so we add the 40 here and we also add the 40 here. So what you now see is, before we actually pay for this thing, we need to look at what the fair values are. There might be intangibles in here that are not recognized, if you like, intangibles here that are not being recognized because they're internally generated. But suddenly, when we deal with consolidated, all these become at fair value according to the standards for fairness ultimately. Right. And those could undergo some impairment. So we'll see that movement from one year to the next revealed through the post acquisition or the post movement. So what am I saying? So the first column shows a fair value of the subsidiary at acquisition, the fair value, and then we can use this to work out goodwill. So goodwill really is the excess. We'll see that now. The second column shows the fair value of the assets at the year end. I mean, I think accounting sometimes is quite fair because the truth is, if you know what the fair value, if you like, of an organization is at the beginning of the year, and you know what the fair value is at the end, any movement is the real profit. Ultimately, that's where we're going. So you don't even sometimes need to know all the internal workings. All you need to know is, well, what's the fair value at the beginning? What's the fair value at the end? That's what the profits are. That's what the change in profits are over the period. Right. And then, of course, the final column shows the differences, if you like. And I write here because, of course, you will definitely have a non-controlling interest. I don't think they'll if they give you a full 100% ownership, that's wonderful, but I doubt it. You'll always have the parent owning like 80%. So we have to think about what's going on with the non-controlling interest. Right. Again, so this is a little side note. If there's a post-acquisition revaluation surplus, so after acquiring the business, then if for whatever reason there's an additional revaluation, which could happen, then you as an owner or part owner will get a share of that post acquisition. I mean, nothing again absurd here. What we're really saying is that after this acquisition, during this period, you have a go up for some reason. So therefore, but this is revaluation. It's not profit. I highlighted this earlier on. You will have a movement here in this revaluation surplus. And so there's a difference. Maybe this was 10, this is now 30. So you now have 20. This 20 must be split. And of course, in effect, this movement here will not go to profit. It can't, right? Because it's not profit. It's a revaluation. It's not taken to retained earnings. It's taken to the revaluation surplus of the parent, if you like. And then the third thing is to working three. So working three now says, so now we can actually work out goodwill. And we'll, again, in the next video, you'll see, I'll take you through an illustration. But the key point now is that we recognize that in some events, most of the time, you would pay more than you should for a subsidiary. So as you can imagine, A minus L equal to C, just because you have here 100 and you have here 50, so you have assets, liabilities 50, like all demand and supply, because you want to, technically you should just pay 50, but you might end up paying 60 or 70 or even 80, just because you want it desperately and you need it for whatever reason. It might be an acquisition that will improve your strategic position, I don't know. But the key point is that you will pay more, and that's what this working through is ultimately trying to calculate. And we'll see why this is important because, again, like I say, now we can recognize goodwill because you can recognize IAS 38 allows us to recognize purchased goodwill. And in effect, purchased goodwill. Ultimately, you're buying intangible, or you're paying for that intangible. Great. And what we will be doing is that there are two ways. We'll see an example, two ways for calculating goodwill. When I say two ways, ultimately, this is the more common, usual method, using the fair value method, where we, again, to make things fair for the non-controlling interest, is that we treat the whole party as one. So they also, if you like, enjoy that goodwill, so to speak. And we can do it from that point of view, where we consider the value of all parties at fair value and then ask, how much have you paid? Or we can focus just on our interest in the subsidiary, and we'll look at that, how much we paid for it. Yeah. So this is what it looks like. So again, it's it really is, again, like I say, quite straightforward if you just look at clearly what's going on. I mean, this is what we're saying. Imagine you owned 100% of it. Let's just imagine. So this is what you've paid for it, ultimately referred to as your consideration. Yes, you've paid. This is what you've paid for this thing. And if you like, this is the fair value, if you like, of all the net assets. And we get that from working two, the very first column. What is the fair value of all these assets when you met them? How much did you pay for them? Right? This would be a scenario where you owned 100%. But if you imagine you owned 80%, and ultimately what we're saying is that if there was a non-controlling interest as well, where we would also then say, well, let's keep on thinking or pretending you owned 100%. So if you were thinking that you also owned 100%, in order to calculate goodwill, we would bring in that 20%. What is the fair value? This is typically given of the non-controlling interest. So we're still talking as though that's 100%. That's what the 100% consideration would have been, if you like, and what is the complete total value of the of that business you're buying, and then that would still be goodwill. I mean, there might be impairment during the year, but in terms of when you first acquire it, that is the goodwill. And again, like I say, the reason for doing it, because you could argue, but oh, we only own 80%, and so oh, well, why don't we just take? Why don't we just get? We have this is what our consideration is. Why don't we just take 80% of the subsidiary, and then just subtract that 80% from our 80% and be gone? Well, simply because when you leave out these minority shareholders, if you like, the value of their organization is or their portion is usually very small. Um, because they're minority or non-controlling interests, and they're not protected. So in order to protect them, we bring them in, if you like, and that means because we're bringing them in, we have to think of them, if you like, as part of our organization, and we will therefore give them the same kind of level of respect and the same level of value, because if they suffer, we suffer. So we will, in effect, ensure the right goodwill is applied, because the right goodwill has been applied to us, the right goodwill has been applied to them as well. Okay, great. This is Yes, I thought this was going to be a shorter video. So what I'll do is I'll stop here, and then yeah, and then just finish off the rest of the theory before going to some illustrations in the next video.